Greetings from the team here at Heritage. I want to take a few minutes today and just reflect on some of the volatility that we're having in the equity markets. We were just talking earlier, we filmed market perspectives, the winter market perspectives on January the 5th, and that was about the time all this volatility started. So I don't know exactly what it was that I said, but I had mentioned I have expectations of heightened volatility. And the reason for that is all around the Federal Reserve and the talk of beginning to reduce this excess liquidity that was put into the market, into the economy really back in March of 2020. And they're starting to unwind all the extra COVID measures, and we're going to start seeing interest rate increases and things. And that tends to make markets a bit nervous. If you remember, one of the more common causes of recessions are the Federal Reserve raising interest rates too far or too fast, which tends to slow things down. I think we're a long ways from that right now. But one of the things we know about investing in equities is we're going to have periods of volatility. And we've had really 22, 23 months of very low volatility since March of 2020. And I think we've had a real strong run up in the marketplace. And I think this is just to be expected. So what do we know? We know that we're going to have volatility in equities. Why do we invest in equities? Because they have a higher expected rate of return. We just don't know when we're going to have volatility or how much is going to go down or up during these periods of time. But what we're seeing is very, very normal for the markets. The S&P 500, which is the broadest index, wasn't even down quite 10%. And through the course of a typical year in the equity markets, remember, we have a drop from the top to the bottom of about 14%. So I think what we're experiencing is normal. I think there's going to be a lot of talk about the Fed raising interest rates, inflation. But I think if we look at what's going on in the US economy right now, barring some unforeseen economic event, I think we're still going to have a pretty good year economically here in the US. And I think that could then transpire into pretty good returns possibly for equities as well as we go forward. So I didn't want to talk long, just wanting to let you know that when we go through periods like this, maybe the best thing we can do is all just minimize our media exposure because that's all we're going to hear about. And everybody's going to talk about inflation, what investments to invest in an inflationary environment. But what we know from history is equities are one of the best asset classes to give us a real return after inflation. So I just want to take just a couple minutes today to say this heightened volatility is normal for the market, especially after the significant run-up that we've seen in the marketplace. Nothing to panic about, but again, it's something if you'd like to visit more about, we're here. I'd love to talk to you more about it. And again, that's really all I wanted to share today is just a quick check-in and just say I think things are going to be okay. And let me know if you have any questions. Thank you.